Okay, good morning and welcome back, everyone. Happy Tuesday and welcome back to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. A lot has transpired since last Tuesday, a lot of volatility in the market. So let's go ahead and get started and discuss what we currently see in the markets and what our outlook is going into this election. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off today by talking a little bit about Q4 and the seasonality analysis around Q4, specifically around an election year, just so you get a better sense for historically, how does Q4 generally play out, especially with an election coming up, and given what we have seen going into Q4. So seasonality analysis to start off with, then we'll take a look at our normal market update. We have, like I said, have seen a lot of volatility. Markets are predominantly still in a very, I would say, upbeat tone. So we want to talk about some of the levels to pay attention to, whether we get above it or if we fail at some of those levels, what that means for the outlook for the next few weeks. We'll take a look at fixed income and commodities. Fixed income markets giving us a lot of some signals here, if you will, is that we want to make sure that we take a look at. Then we'll take a look at the economic indicators, some of the changes that we've seen from economics, both from GDP as well as the services and the shape of the recovery. And then today what we'll do is a final sector review. We'll look at all the sectors, where they currently stand, and which ones are currently strong, which ones are weak, just so you get a better sense for, as you're looking for opportunities in this market, which sectors to focus on. And at the end, if we have a few minutes, we'll do a Q&A here at the very end. But the primary question that a lot of investors are currently asking is really, are markets back in this bullish trend? We've been in a very strong bull market since the March lows, and we've seen a bit of a pause here since the beginning of September. And now we're starting to retest those resistance levels. So the question is, have we started to resume that bullish trend? That's what I want to help you answer using my charts, the economic research that we're currently looking at, the seasonality research, and these sector reviews to give you a better sense for what the outlook is and whether we've resumed that bullish trend here or not. So we'll start off with some basic seasonality analysis. And I always tell investors that, seasonality analysis is something that I get a lot of requests for, but I don't do it very often, simply because I think that in order to do seasonality analysis, you need to take it with a very large grain of salt, because the sample sizes for them are pretty small. We're not talking about a lot of samples to gather this type of data. So, and it's hard to just say, all Q4s are the same. They're obviously not all the same, so it's hard to just take an average across all Q4s and give you some numbers. However, I do think it's interesting to take a look at this. So when we go back and look at all of the Q4 returns in the S&P 500, you'll see that the average October is only about 0.4%, or so. Now, the difference here is the fact that if going into Q4, September is an up month, that number increases substantially to about 1.62%. But if going into Q4 September was a down month, which is what we had last month, the average return in October, sorry, this is for October, not Q4. These are October returns. We see that October is generally speaking down about 0.5%, when September is also down. Now, this happens about 54% of the time. But as you can see, min and max, we have seen also substantial declines as well as substantial increases, even though September was down. So again, big grain of salt, that the averages here are applicable, but it is interesting to take a look at. The other thing that's interesting is that if we take a look at just the election years, all Octobers is actually on average down, especially when September is also down. The average October is actually down about 2.3%. So substantially lower. And this is really what we're going into here. We're going into October in an election year where September was also down, and the average October returns from that is actually down about 2.3%. And as you can see, only 36% of that time has October been up in these particular scenarios. But the sample size here is very small, only 11 times that's ever happened. So again, take this with a big grain of salt. Now, when we look at Q4, this is really where Q4 on average is the best performing quarter of the entire year. The average return of Q4 is 1.9%. And is up 73% of the time. So very high probability that Q4 actually has the highest return. I apologize. Q3 is the highest, Q4 is the second highest, but Q4 has the highest percentage of times when Q4 is up on the year. Now, the most interesting thing for me is the fact that when the S&P 500 when Q3 is down on the year, what we see here is that there's a clear difference in terms of returns. So when we're down through Q3, the average return in Q4 is actually down 0.4%, but Q3 was an up quarter for us. So as you can see, the average Q4 returns when Q3 is up is pretty high, 4.1%. So what that means is that what we're expecting here, especially through an election year, that's even higher, 4.5%. So when you add that up, what we see is that we have a high probability of October being a down month, given what we've seen going into the election year. September is being down. But we see that over Q4, we expect this to actually have one of the highest returns for Q4 going into an election year. So this is really where we believe that we could see a little bit more weakness here in October, but once you see a little bit more weakness, that will likely lead to bigger gains here towards the end of the year. That's seasonality analysis. Again, take this with a very big grain of salt because, again, the sample sizes here are relatively small, and it's not fair to just say all presidential election Q4s historically is going to be applicable here. I do think that we have a very different world that we currently live in with the current election, with the COVID-19, with the stimulus bill. These are all external factors that will likely have a larger effect on Q4 performance than seasonality, but it is a good template to take a look at as to historically what we have seen. So let's now take a look at the market updates. So we've been talking about the QQQ for quite some time, the NASDAQ 100 index, and we talked about a few different levels. We talked about the 270 level, which is the initial level that we hit when we plunged down, the 282 level, which is the subsequent rally after that initial plunge, and we've made a subsequent low here at 260. So from my perspective, there are two levels to really pay attention to, 260 and 282. Yes, last week on Thursday, before we got news that the president contracted COVID-19, the markets attempted to break out above that 282 level. It failed at that level intraday and obviously took a big dip on Friday when the president when we found out that the president had COVID-19. The markets have recovered back to that 280 level or so. It has still failed to break above that 282 level. From my perspective, you need to see a break above 282 in order for markets to resume that bullish trend. So to help answer that question, have markets resumed that bullish trend? The answer is no, but we are very close to it, and this is something that we want to watch here over the next couple of days. I will say that I do think that this is going to be likely news-driven event that drives that catalyst, specifically either a stimulus bill or if we get more clarity as to the president's health and his recovery, as far as, if we do get some better news on that front, that could be the catalyst that drives this market higher here. So stimulus and the president's health, in my opinion, are the news-driven events that are likely going to potentially propel this market back into what we consider a bullish territory. If we look at the S&P 500, last Thursday did not get as high to that 342 level here or so, 343. That's the major resistance level, or the line in the sand that we need to see the broader S&P 500 market get back above in order for it to be a bullish market. If we fail at this market, this is likely the type of weakness that we were looking for in October. And if we do get that weakness into that 330, 323 level, that is, from our perspective, the buying opportunity for a longer-term bullish view here. So those are the two different scenarios that we're paying attention to, and both the NASDAQ, the S&P 500 are well below those resistance levels at the moment. And if we look at small caps have started to really outperform here over the last few days, especially during the sell-off here. The S&P and the NASDAQ pulled back substantially. The Qs really actually starting to retest that 160 level, which is the major resistance level for small caps, going back for multiple years. As you can see, 160 has been a major resistance level. If small caps can break back above it, that really puts it back into that 170 range that it put in back in February. So small caps really coming back to life here. Potentially also this is a good sign for a longer-term structural bullish move here in the markets, because you want to see small caps join the rally. That is more evidence that there is strength in this recovery, and there's a better, in my opinion, route for equity markets to continue to rally. If we look at the equal weight indices, also similar to small caps, showing a lot of strength here over the past few weeks. RSP, the equal weight S&P 500 index, looking to try to get back above 114 and at least 112 in the short run. Those are levels that we'll pay attention to here on the equal weight S&P 500 index. We want to see equal weight also keep pace with the market cap weighted S&P 500. Those are good signs for a market rally, or healthy signs of a market rally. When we look at emerging markets also back into that neutral zone here. We had emerging markets trade sideways for a long time, but started to break down here, but quickly reverse back into, so we're back into that neutral tone here. So we're likely to see more sideways action here on EEM or emerging markets, unless it can break out higher above that 45.5 level here for EEM. Now, the one thing that has shifted a lot over the past couple of weeks is the fact that we had an initial plunge on HYG, which is high yield fixed income. This was coinciding with some of the risk off tone that we started to see shift over the past couple of weeks from treasuries or the fixed income markets. Yesterday, this came rallying back here, back above that $84 level. This was a major line in the sand that we were talking about here for the past couple of weeks. The fact that we got back above 84 certainly is particularly strong, especially when you couple it with the recent sell-off that we have seen in TLT. Now, I will say that the recent sell-off we've seen in TLT is probably more along the lines of fixed income traders really now pricing in a higher probability of a stimulus bill sooner than we had originally expected. We were starting to price in the fact that we weren't expecting a stimulus until probably until next year, 2021, with the new president, with whoever is the new president in 2021. Now we actually believe, especially with the president contracting COVID-19 himself, that there is the possibility of a fiscal stimulus bill prior to the election. And this is the fixed income markets pricing in some of that. So we're seeing yields rise. We're starting to see inflation expectations start to go a little higher. Gold starting to move a little higher off the back of this. So as you see the rotation out of treasuries into higher yielding fixed income markets, that again is more of a risk on environment that traders are heading into. Put call ratios, call buying still continues at a pretty, I would say, accelerated pace compared to what we're normally used to. 20-day put call ratio still at 0.63, 20-week put call ratio at 0.63 as well. So we have a fairly strong call buying environment, that investors are still buying calls at a substantially higher clip than they are buying puts. Gold is back at that 180 support level here. So the question is whether or not gold can break back above that 180 level. If we look at the sell-off here in treasuries and inflation expectations, that certainly points us to a possibility of gold resuming that bullish trend and breaking back above that 180 level. So pay attention to that. When we take a look at the economic numbers, this is really where we still continue to see some surprise to the upside, specifically in sectors of the market that hasn't been particularly strong, services. And the reason that services hasn't been particularly strong is because services is really, when we have services that are not used during the coronavirus, you don't really have pent-up demand for services the same way you do have with durable goods. Meaning if you were going to buy a car before coronavirus, you're going to buy a car right after once you're able to do that. So you have a lot of pent-up demand. But When you don't get a haircut for 6 months, it's not like when things reopen, you're going to get 6 haircuts all in a single month. It doesn't work that way. So services is certainly recovered at a slower pace, but we are starting to see some green shoots here on the services side. So we're seeing services start to surprise here a bit to the upside. Employment is continuing to, employment for the first time got back above the 50 level, which is back into expansion territory. The PMI also uptaking a little bit higher than our survey was expecting to. So we're starting to see better improvements on some of the economic numbers across the board, not just in manufacturing, which is predominantly which has been leading the recovery here, and also some of the 2021 GDP estimates are starting to get revised higher here. Now, I do also want to take GDP numbers with a grain of salt. There's a lot of different contributing factors that go into it. It doesn't mean a whole lot, but it is encouraging to see. Goldman currently is expecting 2021 GDP to come in around 5.8%, which is substantially higher than current consensus, which is about 3.8%. Morgan Stanley also put out the fact that based on the resilience of the economic recovery, they actually believe that there is enough recovery in the current, there's enough progress in the current recovery without a stimulus to actually see real GDP levels recover to pre-COVID-19 levels by the middle of next year. So, and these GDP forecasts are all built on the economic or the shape of the economic recovery and the economic indicators that we currently have. These usually use a mixture of high frequency and lagging economic indicators to forecast this. Now, I will say again, you have to take this with a large grain of salt because they are projecting out pretty far. It's hard to project out that far, but we are seeing some fairly upbeat views here on where the shape of the recovery is going to be into the middle of next year. There are some other ones that are not as upbeat, but we are seeing some I would say revisions to the upside here from most of the major banks. So that is one thing to keep an eye out for. When we take a look at COVID-19 cases, we do continue to see a shift up over the past month or so in terms of new cases. The deaths actually have continued to decline during this phase. So right now the question is whether this continues to move higher here or this starts to plateau out and starts to move lower. Whether we call this a third wave or not is yet to be seen, and especially as we enter into the colder months, whether this is going to see an uptick. This is really one of the things that we're monitoring because there are some talks about specific pockets around the country going back into more restrictions. That obviously is going to dampen the economic recovery and the shape of the economic recovery. So this is one that we are paying attention to quite a bit. We had retail sales come out last week, and when we dig into that retail sales, a lot of the gains in terms of that retail sales actually came from department stores, which we know took a very, very large beating during the coronavirus, whereas opposed to brick and mortar, discount stores actually saw an increase in terms of spending. We obviously saw department stores nearly collapse to 50%. And we're starting to see a bit of that recovery. So when we look at Nordstrom, when we look at Macy's, trading at pretty much rock bottom, this is potentially, a turnaround story for some of those stocks. So this is one of the areas that we are paying attention to, for those of you that are looking to seek some bargains, if you will. We have seen retail department stores start to pick up a little in terms of activity. So with that, what I do want to take a look at is the major sectors and do a review of the major sectors. We start off with materials, one of the stronger rotations that we've seen out of the S&P 500. Materials remains above, the highs of 2019. And the February 2020 highs here. Materials actually fairly strong here. After that initial plunge, actually managing to get back above the highs from that initial plunge. There is a gap that it has to fill here, just shy of the $66 level. So we want to see materials get up to that 66 level, which I believe should be fairly soon in the next couple of days, and see if we can get a break above that gap. If it fails at that gap, then we're likely to come back to revisit the $60, $62 level here on materials, but materials certainly looking fairly strong here on the year. If we look at industrials actually looking a little stronger than materials from the perspective of it is really very close to revisiting the all-time highs and potentially, revisiting its recent highs and potentially revisiting its all-time highs around this 85.5 level here. So industrials are very close to a breakout here to the upside. So I do think industrials potentially one of the sectors that could be leading the S&P 500 or the markets higher here, especially as we see a little bit of rotation out of tech. And I think especially as the polls starting to point towards a Democratic sweep, the polls starting to point towards a Biden victory, technology companies are potentially at risk here because of the implications of, potentially breaking some of the tech companies up. Those are some concerns that investors have in technology. So as we move into that, materials, industrials, these are some of the sectors that have seen some strong rotation into. So those are ones that I think are worth paying attention to. When we look at communications is very much still in a more of a neutral tone here, as you can see here, still kind of in a small downtrend, hasn't managed to break back above it and start resuming that bullish trend here. So this is one that we're paying attention to. However you want to draw the lines, you could draw it this way and say that we have broken here to the upside. From my perspective, this is a pretty significant downtrend here. So I think at best we're still in neutral tone. If we need to really see a break above that $62 level in order to resume a bullish trend here for communications. So communications is not as strong on this recovery as some of the other sectors. When we look at real estate continues to underperform as it trades sideways. What that means is that as markets move higher, but this sector is moving sideways, it's certainly moving sideways from an absolute basis, but it's moving lower from a relative basis. And that's really what we're paying attention to here. So from my perspective, I think this $37, $38 level here is likely going to be a short-term cap here, and you're more likely to see some sideways action here from XLRE, the real estate ETF. Same thing here for XLF. XLF seeing a little bit more of a move here over the past couple of days, because as yields rise higher, XLF has started to move higher. This is part of why we did I do think that from we take a look at the 200-day moving average. This is one that is likely to face a little bit of resistance here from the 200-day moving average. If we can get a break above the 200-day moving average, we certainly could potentially see a slow rotation into XLF. And we have seen arguably a bit of rotation into XLF because the initial plunge here was substantially lower than the rest of the market. So just XLF providing some protection because it's one of the weaker sectors during that initial plunge. It's moving a little bit higher off of the lows versus the other sectors. So we have seen some rotation into XLF. It's been a very slow rotation, I will say, but there is some rotation into XLF, and it may not, and we may start to see some outperformance here and perhaps move away from that second worst performing sector behind energy. When we look at consumer discretionary, this still remains the strongest sector, even stronger than technology. So XLY actually just shy of those highs that we're referring to. So after the initial plunge, it came back to retest these highs twice. It is now back at those highs. And this is really one of the sectors that we do see potentially gaining some strength and breaking above that, especially as we start to see consumer spending continuing to recover, especially if we continue to see hopes of a stimulus bill, especially if we get a stimulus bill. This is one of the sectors that we do see substantial upside here, especially breaking above that recent high, that all-time high, and then continuing on higher here. So XLY, certainly one that I'm going to be paying attention to very closely. If we look at XLP, similar to what we were showing you here before in XLC, which is the fact that, we have this downtrend. It has sort of broken that downtrend, but it's now very much in more of a neutral tone here. Between the $66 level and $62 level, I expect XLP to be more of a range bound unless you get that breakout here. We have also seen a little bit of rotation here into staples, a slow rotation, but we do see a rotation nonetheless. So this is also one that, if things get a little weaker here in October, I do see XLP being able to play a little bit of defense. We saw Costco break out higher here. We see a lot of the staples, especially as COVID cases continue to rise. And perhaps if we go back down into more restrictive state in certain places, XLP is certainly going to likely play a little bit of defense on that type of weakness. When we look at utilities, very similar to real estate, utilities moving sideways. So as the markets are moving higher, when this ETF or this sector is moving sideways from an absolute basis, that actually means that it's moving lower from a relative basis. So again, we see XLU very much range bound here. So I expect the same thing here for XLU, is to trade more of a range bound motion unless it can break out here above the $63, $64 level with a significant movement here, which I don't particularly see a strong fundamental thesis for. So this is one that, from my perspective, is likely going to continue underperforming the overall market. When we look at XLV, XLV has been strengthening a bit. Now, XLV initially off of the March lows was the strongest sector, and then over the past past 3 or 4 months have really started to underperform the market, because this is when the markets were moving higher. XLV was not moving as high, which means that on a relative basis, it was starting to fall behind. We have seen XLV come back to life a little. As you can see, XLV is just shy of that 107 high here. If we can get back above 107, that puts 110 back in contention and potentially a breakout above 110. I do think that, as the cases of coronavirus start to uptick a little, as we get closer and closer to the vaccine, we see a little bit more interest from XLV. We also notice, IBB rallying here over the past couple of days. So XLV starting to see a little bit of rotation into healthcare. So this is one I also think worth paying attention to as we're looking for some upside into that October weakness. XLK, similar to XLV, not quite as strong, but is certainly gathering strength here. I do think that the investors do see a little bit of risk here, especially as we go into the election and the risk of a Democratic sweep with Biden victory. This is one of the sectors that has a negative impact from that outcome of the election. So I think investors are a little less exuberant here on XLK than they are perhaps on XLY. By all means, still one of the strongest sectors, likely to remain one of the strongest sectors, but we do see some of the big cap names in this particular sector trading at a little less, I would say, optimism than we have seen historically. And lastly, XLE. Is this a temporary bottom here for XLE? Crude oil actually continues to decline. We have seen California put out, that regulation that by 2035, they want to get rid of all gas guzzling cars. China just came out with a huge initiative for 2050, 2060 to reduce carbon emissions. So this is really one of the sectors that long term I don't particularly think is going to see this huge recovery that some investors are perhaps seeking here. So XLE, I think that you could get these spikes here to the upside, but long term, my views are that this is still the worst performing sector and will likely to be the worst performing sector until it becomes a sector that no longer effectively exists in 10, 15, 20, 30 years or so. So that is where we currently sit here in the broader markets. Like I said, a lot has transpired here over the past couple of days. Really important to pay attention to what's currently going on in the markets. So with that, I want to thank you for taking the time out here this morning. I hope that this was useful in helping you start out your day, and I will see you guys here next week. Have a great day and happy Tuesday.